Right now, there are professional investors out there working like 80-hour weeks.
Oh, yeah, absolutely destroying their health and sanity in the process.
Exactly. Sacrificing their marriages and everything, just using these massive supercomputers to squeeze out, what, maybe an extra 0.1% return from the stock market?
If they are lucky, right?
Yeah.
I mean, they dedicate their entire existence to optimizing this tiny, tiny fraction of their financial life.
Meanwhile, the same brilliant, highly educated people are completely ignoring a massive, easily fixable 3 or 4% hole in their own personal bank accounts.
That's crazy.
It is crazy. Today, we are looking at why brilliant people do incredibly stupid things with their money.
We really are stepping away from the pristine, perfectly predictable world of, like, financial calculators today.
Yeah, and we are wading deep into the murky, highly emotional waters of human psychology. Welcome to the deep dive.
It is the absolute definition of psychological muddy waters. I mean, usually when we talk about personal finance, there's this expectation of mathematical precision.
Right, like a spreadsheet.
It's exactly.
Yeah.
It's presented to us as a closed system. You plug in your income, you subtract your fixed expenses, you project a theoretical 7% annual return, and boom, the calculator spits out your exact retirement date.
Which feels great, right? It's comforting because we crave those formulas. We want our futures to be completely visible and categorized.
But then you step out of the spreadsheet and you step into the real world.
You step into a world of ego, of massive, unpredictable global events, of status games with your neighbors, and suddenly that pristine financial calculator is completely broken.
It shatters completely.
So today our mission is ambitious. We are going to attempt to entirely reframe how you view money.
And just to be clear, this isn't about stock picking. We aren't looking at investment strategies.
No, we are looking at an excerpt from a document simply titled 09savemoney.pdf, specifically a section labeled 10 Save Money.
This is about psychology. It is about taming your ego, and it is about the literal ownership of your own time.
And ultimately, it is about survival in a hyper-competitive, globalized world.
So to set the stage here, there's a profoundly simple visual anchor we need to start with from the source material.
Right, the image with the quote.
Yeah, it's just a stark black and white statement, but it completely flips traditional finance on its head. And it says, quote, "The only factor you can control generates one of the only things that matters. How wonderful." End quote.
How wonderful. I just love the tone of that. It's almost a sigh of relief, like it takes the pressure off entirely.
It really is a release because it strips away all that illusion of complexity.
Right.
The text explicitly notes that past a certain basic level of income, like once you are no longer struggling just to put food on the table, people generally fall into three distinct groups.
Okay, let's break those down.
First, there are those who save. Second, there are those who don't think they can save. And third, there are those who don't think they need to save.
And let's be explicitly clear right up front. If you are listening to this right now and you fall into group 2, you think your budget is cut to the absolute bone and you cannot wring another single dollar out of your life.
Or if you fall into group 3 and you think your income is so astronomically high that budgeting is like a quaint concept for people who earn less than you.
Right, exactly. If that's you, this conversation is an intervention. This deep dive is directly for you.
So let's start by addressing the core illusion of personal finance. It's an idea that is incredibly simple, but universally overlooked.
What exactly?
That building wealth actually has very little to do with your income. It has very little to do with your investment returns and almost everything to do with your savings rate.
Okay, wait, let's unpack this right away, because intuitively that just feels wrong.
Oh, it totally feels wrong to most people.
Right, because earning more money feels tangibly, undeniably rewarding. You get that promotion, you land that bigger client, you physically see the paycheck get larger, and your brain just floods with dopamine.
Oh, absolutely. Society conditions us that way.
So if increasing our income feels so tangibly rewarding, why does the author argue that saving, which traditionally feels like a restriction or a punishment, like you're putting yourself in a financial straitjacket, is actually the clearer path to destiny?
Well, isn't focusing on growing our income just basic human nature?
Yeah, that's exactly what I'm asking, isn't it?
We are absolutely biologically and culturally conditioned to obsess over the top line. The top line is your salary. It's your revenue.
It's the big flashy number you can drop at a cocktail party.
Exactly. Society entirely celebrates the top line. But wealth is the bottom line. It's simply what you keep.
So why is focusing on the top line so dangerous?
The reason this concept is so painfully counterintuitive is because relying on massive investment returns or relying on giant income bumps requires relying on external forces.
Oh, I see.
When you focus on the top line, you are placing your financial destiny entirely in the hands of other people.
You're handing the steering wheel over to your boss or the corporate hierarchy or the Federal Reserve or just the absolute chaos of the global stock markets.
Precisely. You are standing in a field hoping the wind blows in your direction. You are hoping for favorable weather.
And you can't control the weather.
Right. Can a massive bull market make you rich? Absolutely. But whether a specific investing strategy will work or how long it will work, or whether the markets will cooperate next year or crash by 30%, all of that is shrouded in complete uncertainty.
It is completely out of your control.
But your personal savings rate, however, is a different animal entirely. It is 100% within your control.
It has a guaranteed, mathematically certain chance of being as effective in the future as it is today.
Yes. And the text provides a perfect historical precedent to prove that efficiency always beats acquisition.
Right. To really hammer this home, we aren't just going to look at personal bank accounts. If you want indisputable proof, we just have to look at macroeconomic history.
And this is where the perspective completely shifted for me. We need to go back and look at the 1970s oil crisis.
This is the perfect historical mirror for our personal finances. Let's paint the picture of the 1970s for a second.
The global economy was growing at a blistering pace. It was consuming colossal amounts of oil, and the rate at which we could drill and extract that oil simply couldn't keep up with the demand.
The calculation at the time was terrifyingly simple. The world legitimately looked like it was running out of fuel to keep civilization running.
Right, there were doomers everywhere predicting the end of the industrialized age.
People were waiting in lines for hours just to get a few gallons of gas. The panic was palpable. It felt like an unsolvable math problem.
But we didn't run out of oil. The industrialized age didn't end. And here's the absolute kicker. We didn't survive that crisis, primarily because we suddenly discovered massive new underground oceans of oil.
We didn't even survive it because we got vastly better at extracting the oil we already knew about.
Exactly. We survived because we completely changed the demand side of the equation. We stopped trying to acquire more, and we started becoming fiercely efficient with what we had.
We started engineering cars and factories and residential homes that simply required less energy to function.
Let's luxuriate in these specific stats for a minute, because they are staggering. Think about this. The United States uses 60% less energy per dollar of GDP today than it did in 1950.
Let that sink in. It takes 60% less energy to generate the exact same unit of economic value.
And the vehicle data is even more granular and mind-blowing. The average miles per gallon of all vehicles on the road has literally doubled since 1975.
And there is a specific jarring comparison from the source that perfectly illustrates how far this efficiency went. Let's look at a 1989 Ford Taurus sedan.
A totally average, mundane, mid-size family car from the late 80s.
Exactly. It averaged 18.8 miles per gallon. Now fast forward 30 years and look at a 2019 Chevy Suburban.
We are talking about an absurdly large SUV, right?
A literal tank rolling down the highway that weighs over 2.5 tons. That massive 2019 vehicle averages 18.1 miles per gallon.
It's an incredible engineering miracle. We took the efficiency gains over 30 years, and instead of just using less gas, we used that massive surplus of efficiency to power vehicles that are twice the size and twice the weight, while still getting slightly better mileage than a standard family sedan from 1989.
The broader takeaway here is that the global economy grew its energy wealth not by increasing the energy it had, but by radically decreasing the energy it needed to perform a task.
The math is undeniable. Since 1975, U.S. oil and gas production has increased by roughly 65%. That sounds like a big win on the acquisition side.
But over that exact same period, conservation and efficiency have more than doubled what we can actually do with that energy. It is so mathematically clear which factor mattered more in saving the economy.
Efficiency completely lapped acquisition.
And if we connect this to the broader philosophy of how we approach problems, it perfectly explains why focusing on acquisition is so stressful.
Right, because finding more energy relies on this slippery, unpredictable mix of having the right geology, the right geography, favorable weather patterns, and incredibly stable geopolitics.
Which is a nightmare of variables you can't control. You can't control if there is a massive oil deposit sitting under the ground you happen to own.
And you certainly can't control if a foreign nation on the other side of the planet decides to embargo exports and spike the price of a barrel overnight.
Exactly. It's completely out of our hands. Conversely, becoming more efficient with the energy we currently use is largely, if not entirely, in our control.
The decision to buy a lighter car, the decision to insulate your attic, or the decision to simply ride a bike to work is entirely up to you. It has a 100% chance of improving your personal energy efficiency.
There is no geopolitical risk in insulating your roof.
None at all.
So what does this actually mean for you, the person listening to this right now? How do we map the massive macroeconomic oil crisis of the 1970s directly onto your monthly bank statement?
It's a great analogy.
I want you to think of your personal household exactly like the U.S. economy in the 70s. Your income is the oil. Your lifestyle is the economy consuming that oil.
You don't need to strike oil to become wealthy.
Right. You don't need to land a massive unexpected promotion or win the lottery or pick a penny stock that goes up 1,000%. You just need to make the engine of your lifestyle run on less fuel.
The outcome, the actual accumulation of wealth in your bank account is exactly the same, but you control the thermostat.
If you view building wealth as something that requires more money or requires massive investment returns, you are going to become just as pessimistic and anxious as those energy doomers in the 1970s.
Because the path forward looks incredibly hard, incredibly risky, and entirely out of your control.
But if you view wealth as something powered by your own personal frugality and your own efficiency, your financial destiny becomes crystal clear. It is entirely in your hands.
Which brings us to a definition of wealth from the text that is so remarkably humbling. It strips away all the pretense.
Wealth is just the accumulated leftovers after you spend what you take in. That's it.
It's not a fancy portfolio, it's not the zip code you live in, it's just the leftovers.
And because you can absolutely build wealth without a high income, but you have absolutely no chance of building wealth without a high savings rate, it is mathematically undeniable which one is more important.
But we need to go a step further into the math of what we call lifestyle bloat. Because the reality is that the absolute value of your wealth is entirely relative to what you actually need.
Yes, let's walk through a hypothetical scenario to illustrate this, because this is where the math really shifts your perspective. I call this the marathon analogy.
Walk us through it.
Let's say you and I have the exact same net worth today. We are starting from the exact same financial baseline. And let's say you are a vastly superior investor.
Okay, I like this scenario already.
You are out there studying the markets, reading earnings reports, and you can consistently earn a 12% annual return on your money. I am a much lazier, worse investor. I just buy a basic index fund, and I only earn an 8% annual return.
Well, in traditional finance, I am the clear winner here. I am a genius. 12% beats 8% every single time.
Right. If this were a marathon, you are running a 6-minute mile, and I am slogging along at an 8-minute mile. But then we introduce the efficiency variable.
This is where it flips.
Let's say I am much more efficient with my money. I have structured my life, my ego, and my desires so that I only need half as much money to be perfectly happy as you do.
Meanwhile, my lifestyle expenses compound and grow just as fast as my asset returns.
Exactly. You make more money, so you buy the bigger house. You get a better return, so you lease the luxury car. You upgrade your vacations from domestic to international first class.
The math here is fascinating and brutal. In this scenario, the 8% investor, the one who needs less, is ultimately far better off in getting vastly more actual, tangible benefit from their investments.
Despite having mathematically lower returns because your required baseline is so much lower?
If I am the 12% investor, but my lifestyle expands to consume every dollar of that return, I am running a 6-minute mile, but I keep moving my own finish line further away.
You move it from mile 26 to mile 30, then to mile 40. You are running faster, but you are never, ever going to finish the race.
Learning to be happy with less money creates a massive gap between what you have and what you want.
And that gap is functionally identical to the gap you get from growing your paycheck. It's the exact same surplus.
But creating that gap through frugality is vastly easier. It carries zero risk and is entirely within your control.
Which highlights the sheer undeniable absurdity of the professional finance world as described in the source.
Think about how much time, stress, and human capital goes into achieving tiny increments of investment outperformance.
Wall Street is built on millions of hours of research, tens of billions of dollars of effort, from highly educated professionals, sophisticated algorithmic trading models, underwater fiber optic cables.
All to add maybe a tenth of a percentage point, 0.1% to their annual returns.
It's madness when you frame it that way. These professional investors are grinding 80 hours a week, accelerating their own aging process, never seeing their kids, just to squeeze out a 0.1% advantage over the market.
Meanwhile, right there in their own personal lives, in their own household budgets, there are likely 2 or 3 full percentage points of lifestyle bloat that could be exploited and captured with almost zero effort.
Here's where I want to push back or at least play armchair psychologist for a minute,
Yes.
because this is really interesting.
Go for it.
Why is there this massive glaring blind spot? We are talking about brilliant, highly rational, mathematically gifted people.
Yeah, they aren't stupid.
Why do they put millions of hours of intense research into one side of the finance equation, the returns, and completely, utterly ignore the massive low-hanging fruit on the other side? The frugality and the lifestyle bloat. It makes no logical sense.
Well, it doesn't make logical sense because it's not a logical problem. It's a profound psychological problem.
Uh-huh.
To answer why we allow lifestyle bloat to consume our wealth, we have to transition away from the pure mathematics of money and step into the deep, often deeply uncomfortable psychology of spending.
Uncomfortable is the right word.
The reality is that past a certain relatively low level of income, what you need is just whatever sits below your ego.
Whatever sits below your ego, that is a heavy sentence. And if we look in the mirror, it is an incredibly uncomfortable truth.
It really is. Let's break down spending into tiers to see how ego infiltrates our wallets.
Okay, let's do it.
First, everyone absolutely needs the basics. Food, shelter, basic clothing, essential health care. You cannot ego hack your way out of needing a roof over your head.
Right, biology demands that.
Once those basic survival needs are covered, there is another level of what we might call comfortable basics.
And past that, there are basics that are comfortable, entertaining, and enlightening. Books, local travel, hobbies that genuinely enrich your life without breaking the bank.
But then we cross a threshold. We cross the ego line. The undeniable truth is that spending beyond a pretty low level of materialism is almost entirely a reflection of ego approaching income.
Ego approaching income, so it is spending money purely to show other people that you have money.
Exactly. Or perhaps even darker, it's spending money to show people that you had money before you spent it all on the shiny object you're currently showing them.
This brings us to what might be the single most profound psychological insight of this entire discussion.
Which is that if you want to build wealth, one of the most powerful ways to increase your savings isn't to raise your income, it's to raise your humility.
Raise your humility. I had to stop and physically put my pen down when I first processed that idea. We never, ever think of saving money as a moral or psychological exercise.
We think of it as an accounting exercise.
But savings is literally defined here as the gap between your ego and your income.
If you define savings as the gap between your ego and your income, it suddenly illuminates why so many people with genuinely high 6-figure or even 7-figure incomes save absolutely nothing.
They are broke at a higher level.
They aren't struggling to pay for calories or heat. They are engaged in a daily, exhausting, invisible struggle against their own social instincts.
The visual metaphor for this from the text is so vivid and so accurate. It's the biological struggle against the instinct to extend your peacock feathers to their outermost limits and keep up with others doing the same.
Think about the sheer exhaustion of that. You get a raise, so you fan your feathers out a little wider. You lease the luxury SUV.
But your neighbor just fanned their feathers out too. They just put in a custom pool.
So you had to fan yours out even further. You renovate the kitchen. That was perfectly fine. It is a never-ending, highly stressful, zero-sum biological arms race of status.
Think about the last time you got a raise. Did you actually keep it, or did your car lease suddenly get an upgrade? I know mine did. I'm totally guilty of this.
We all are. We are running on a hedonic treadmill where the speed keeps increasing,
Okay.
but we never actually move forward.
And this is precisely why enduring personal finance success doesn't necessarily belong to those with the highest incomes or the highest IQs.
It belongs to those who have a cultivated propensity to simply not give a damn what others think about them.
It is a superpower. Not giving a damn is a literal monetizable financial superpower.
It absolutely is.
Yeah.
Because the chain reaction of wealth building is flawlessly logical once you remove ego from the equation.
How do you create savings? You spend less.
How do you spend less? You desire less.
How do you desire less? You care less about what others think of you. The reality is that money relies far more on psychology than it does on finance.
But here is the trap of taming that ego. Let's say we do it. We master our ego, we retract the peacock feathers, we stop caring about the neighbor's pool, and suddenly we create this gap
We have actual savings building up in the checking account.
Human nature immediately demands that we give that cash a job. Standard financial advice dictates that every single dollar must have a destination. You must save for a specific goal.
You open a sub-account labeled down payment or a new car or vacation or retirement.
Yeah,
We just trade an ego-driven goal for a material goal.
right. The conventional wisdom is that undirected money is wasted money.
But we need to boldly counter this. The text boldly counters this. You do not need a specific reason to save. You can, and indeed you should save, just for saving's sake.
This requires a massive mental shift. We have to unpack the philosophical difference between a predictable world and the world we actually live in.
Saving for a specific tangible goal only makes sense if you live in a predictable world.
If you know exactly what your career, your health, the economy, and the housing market look like for the next 5 years, sure, save exactly $40,000 for that specific car.
But our world isn't predictable, not even slightly.
In our deeply unpredictable reality, saving isn't about buying a specific object in the future. Saving is a hedge against life's inevitable ability to surprise the hell out of you at the worst possible moment.
Okay, I have to jump in here and admit genuine struggle with this concept. Let's play devil's advocate for the listener for a second.
Sure, what's the pushback?
I'm looking at my own life right now, and if I don't have a specific, exciting vacation booked or a tangible, shiny object at the finish line, I will absolutely spend that surplus money on expensive takeout or Amazon impulse buys.
It's hard to stay motivated.
It is incredibly hard to motivate yourself to save without a shiny object. Intellectually, I agree with you, but practically, telling me to save for an invisible, abstract future crisis just makes me incredibly anxious.
It feels like you're just hoarding nuts for a brutal winter you hope never comes.
Exactly. How do you actually reprogram your brain to shift your mindset from I am saving for a vacation to I am saving for a totally unknown crisis without getting totally depressed?
That is the exact friction everyone feels, and it's a completely fair pushback. The way you reprogram your brain is by pivoting from the defensive benefit of saving
Which is merely avoiding bad surprises, which is depressing to think about.
to a highly optimistic offensive benefit described in the text, and that offensive benefit is the intangible acquisition of time and autonomy.
Yes, the intangible stuff. We all know the tangible stuff: money buys houses, cars, designer clothes, jewelry.
But the intangible benefits of money are harder to wrap your head around, but far more valuable than tangible goods.
Savings without a specific spending goal gives you options. It gives you extreme flexibility.
It gives you the ability to wait, and it gives you the opportunity to pounce when the time is right. It gives you time to think.
Yeah.
It lets you change course on your own terms rather than being forced to react to circumstances.
The framing of this idea from the source is what really gave me goosebumps. Think about this sentence, quote, "Every bit of savings is like taking a point in the future that would have been owned by someone else and giving it back to yourself," end quote.
Stop and think about what that actually means for your daily life.
If you have no savings, your future time belongs to your boss, or it belongs to your credit card company, or it belongs to whoever is willing to pay you just enough to survive.
You are forced into total compliance.
When you save money, you are literally buying Tuesday the 14th of next month back from your boss. You own it again.
That flexibility, that ultimate control over your time, is the unseen, unmeasured return on wealth. We need to explore this concept of the incalculable return on cash in the bank.
Because in modern finance, we are so aggressively obsessed with interest rates. We constantly ask, what is my high-yield savings account paying? Is it 4%? Is it 4.5%? Should I move banks to get 5%?
Right, we optimize for the decimal points. But what is the return on cash in the bank that gives you the option of quitting a toxic job and changing careers entirely?
What is the return on cash that allows you to retire 5 years early? Or just the pure, unadulterated freedom from waking up at 3 a.m. with a knot of financial worry in your stomach?
The return on that cash is incalculable in two distinct ways. First, it's so large, so massive, and so fundamentally important to human happiness that we literally cannot put an accurate price tag on it.
And second, it is mathematically incalculable. We cannot measure peace of mind on an Excel spreadsheet like we can measure an annual percentage yield.
And unfortunately, human nature dictates that what we cannot measure, we tend to ignore and overlook.
We completely ignore the peace of mind because we can't chart it on a line graph for our financial advisor. But the reality is that even if your savings are sitting in a checking account, earning literal 0% interest, that money might actually be generating the most extraordinary return of your entire portfolio.
Exactly. How does it generate that return? Because if you lack control over your time, You are forced to accept whatever bad luck is thrown your way.
If your company restructures, your department gets slashed, and your new manager is highly abusive, you have to stay and take the abuse because you need the paycheck to cover your bloated lifestyle. You have zero leverage.
But if you have extreme flexibility, if you have unallocated savings, you have the time to wait. You have the leverage to walk away. You have the flexibility to take a new job with a lower salary but vastly more purpose and better work-life balance.
Or, if we look at the investing side, you can wait for incredible opportunities that only arise when the people who expanded their peacock feathers lacked flexibility and didn't save, turn desperate, and are forced to liquidate their assets cheaply.
So this isn't about numbers on a screen anymore. This is about buying your own autonomy.
What is the literal price tag of freedom from worry? As the source says, it's so large we can't price it, and so abstract we can't measure it, which is exactly why most people overlook it. We optimize for the 0.1% market return instead of the absolute freedom of owning our own time.
And to fully grasp why this is so critical right now, we need to pull back and take a very macro historical view.
We need to understand why this hidden return on savings, this ultimate flexibility, is becoming exponentially more important in the modern era than it was for our parents or grandparents.
Yeah, this part of the historical context is incredibly sobering. It forces you to look at the global talent pool.
Let's rewind the clock, just over 100 years ago. The world was hyper-local. The text pulls back to this view. A century ago, roughly 75% of Americans had neither telephones nor regular mail service. They were completely disconnected.
Because of that, severe isolation competition for jobs and status was strictly hyperlocal. If you were a worker with just slightly above average intelligence, you might actually be the absolute smartest, most capable person in your town.
And because you were the best in your town, you got treated like the best, you got paid like the best, and you held all the leverage.
You didn't have to compete with the vastly smarter, harder working person who happened to live 3 towns over because there was no mechanism for them to take your job.
But that world is entirely permanently gone. Today, we live in a hyper-connected, fully digitized world. Global boundaries have been completely erased.
There's that famous quote from the venture capitalist Mark Andreessen, "Software eats the world."
What that actually means for your career is that the talent pool you are competing in has gone from maybe a few hundred people in your zip code to millions or even billions of highly educated people spanning the entire globe.
And this isn't just about factory jobs moving overseas anymore. This is especially true for jobs that rely on working with your head rather than your hands.
If you are in teaching marketing data analysis, consulting, accounting, programming, journalism, even fields like medicine and law are increasingly competing in global digitized talent pools.
So if you are a software engineer in Silicon Valley or a graphic designer in London, you are now directly competing with a self-taught prodigy in Estonia or a highly motivated team in Bangalore who will do the job for a fraction of the cost.
So you have to ask yourself the critical question. As the range of your competition expands to literally everyone on Earth with a Wi-Fi connection, how do I stand out?
And the chilling reality is that I'm smart is an increasingly terrible answer.
It is a terrible answer because the math of a globalized world dictates that there are a lot of incredibly smart people out there. Raw brain power has essentially been commoditized.
Let's look at the SAT statistics from the source to really put the sheer scale of this into perspective.
For anyone out there relying solely on their raw brain power to coast through life and stay ahead, listen to this. Almost 600 people ace the SATs every single year. A perfect, flawless score.
And another 7,000 people come within a tiny handful of points of a perfect score.
In a winner-take-all, hyper-globalized economy, those thousands of absolute certified geniuses are now your direct competitors for that remote consulting job or that lucrative programming gig.
Which means intelligence is no longer a reliable advantage. It is necessary perhaps to get your foot in the door, but it is absolutely not sufficient to keep you there. It is not sustainable as your only competitive edge.
So what is the edge? If raw brain power is basically commoditized now, what replaces intelligence? It feels like the only moat left is endurance.
Just the sheer ability to wait out the competition or pivot when the ground shifts beneath you.
Is that what the savings rate actually buys you?
Precisely. The expert synthesis of the text's grand conclusion is that flexibility is the new competitive advantage.
In a world where highly technical skills are rapidly becoming automated by AI and software, and where raw intelligence is globally hyper-competitive, the actual competitive advantages tilt heavily toward nuanced, deeply human soft skills.
We are talking about things like elite communication, genuine empathy, and most importantly, the financial flexibility to adapt.
And how do you buy that flexibility? You buy it with a high savings rate. If you have unallocated savings, you have the financial leeway to learn a completely new skill at your own pace when your old industry gets disrupted.
You can afford to take 6 months off to retrain or find a new routine without starving or losing your home.
You don't feel that frantic, breathless, terrifying urgency to chase competitors who can do technical things you can't. You have the runway to find your passion, to find your exact niche, and to execute at your own pace.
The ability to do those things, to step off the treadmill, to radically reevaluate your career, to learn at a slower, deeper pace when most other people are trapped by their car payments and simply cannot afford to do so, is one of the very few things that will actually set you apart in the modern economy.
Control over your time and your options is rapidly becoming one of the most valuable currencies in the world.
It's incredible how this all connects back perfectly. We started with the mathematical truth that personal efficiency in your savings rate will always beat your absolute income level.
We then waded through the deep, uncomfortable psychological battle of ego versus humility, and how keeping your peacock feathers firmly retracted is the actual mechanical key to creating that wealth.
And we ended with the realization that in this hyper-competitive, globalized world, the flexibility and time that those savings buy is the ultimate competitive advantage.
It is the key to surviving and thriving when raw intelligence alone is no longer enough to protect you.
It is a fiercely logical, brilliantly structured, undeniable argument for why everyone can and why everyone absolutely should save more money. It removes all the excuses.
But just when you think you have it all figured out, just as we have spent this entire hour building this bulletproof, highly rational step-by-step case for the logic of saving money, there is an absolute curveball.
Yes, the final thought we need to leave you with from the very end of the source material is actually a severe warning.
What is it?
After everything we've just discussed about the logical, mathematical, and historical imperative of saving, the author's final instruction on the topic is, quote, "You know what else they should do? Stop trying to be so rational. Let me tell you why." End quote.
Stop trying to be so rational. We've just spent this entire deep dive meticulously mapping out the precise logical mechanics of time, ego, compound interest, and global competition, and the final instruction is to abandon pure rationality.
It's a brilliant paradox, and it forces you to completely reevaluate everything you thought you just learned about money.
It suggests that there is a hard limit to logic when dealing with human beings. Because humans aren't spreadsheets. We are emotional, irrational, messy creatures, and sometimes trying to be perfectly rational with our money is the exact thing that causes us to fail.
And that profound paradox is exactly where we will leave you today.
Take that thought. Look at your own balance sheet. Look at the literal physical objects in your home and ask yourself the uncomfortable question: where is my ego currently spending my future freedom? Are those peacock feathers really worth the Tuesday you're giving away next month? Thank you so much for joining us on this deep dive. We'll see you next time.